Okay, so now that we've discussed, we've had a little bit of a review over the statement of cash flows. We didn't talk about that, but that's okay. That the statement of cash flows is not directly related to the closing process, which is what we're talking about right now. So we had a little bit of a review of the income statement, retained earnings statement, sometimes called the statement of retained earnings. I think I saw that in one of your homework questions for this week. And then finally the balance sheet. Okay, and then we discussed permanent accounts, which were all of the balance sheet accounts, at least the balance sheet accounts that show up on the balance sheet. And then we talked about temporary accounts, which are all of the income statement accounts plus the dividend accounts. So with that in mind, at the beginning of the next period, temporary accounts should have zero balances. And the most obvious reason for that, if you think about it, is sales revenue. At January 1, when we open up whatever business we have on January 1 or January 2, because we're probably off on January the 1st, we want our sales for that year to be zero until we make our first sale, right? So temporary accounts should have zero balances. It says to achieve this, temporary account balances are transferred to permanent accounts at the end of the accounting period through journal entries. Okay, now hold that thought and let's continue. It says the entries that transfer these balances are called closing entries. And the transfer process is called the closing process, sometimes referred to as closing the books. After the closing entries have been posted, all of the temporary accounts have zero balances. Okay. Now, you're going to find that this might, if you're reading along here, you might think, well, that sounds pretty straightforward, and it is. I think the slide makes it sound a little bit more straightforward than it actually is in real life, but that's okay. Let's go to and see how we actually do this now, and hopefully you won't become too overwhelmed. So it says, let me just say this. Let me just make sure here. Yeah. These next few slides are incredibly important if you want to understand the closing process. So it says here, the closing entries involve the following 4 steps. Revenue account balances are transferred to an account called income summary. Now, on the previous slide, it said that temporary accounts are transferred to permanent accounts, and that is the truth. Okay? But what it didn't tell you is that those income statement accounts and dividends, specifically the income statement accounts, have to be transferred into another temporary account just momentarily. So income summary is another temporary account, but this account is only used during the closing process. It's not used at any other time. Okay? So this is the only time that income summary serves a purpose, and that we will use it in accounting. It says here the exact same thing. It says income or expense account balances are transferred to an account called income summary. So if you think about this, steps 1 and 2 are the exact same thing. It's just that we're going to be doing it for revenues and we're going to be doing it for expenses. Okay? Now, step 3, it says the balance of the income summary, which is going to be net income or net loss, is transferred to the retained earnings account. Now, I want to spend some time on number 3 if you don't mind, and even if you do. Let's think about this. It says the balance of income summary, and then it says net income or net loss. So what it's saying here is that if our revenues the amount of revenues that we have that we're transferring into income summary is higher than the amount of expenses, we have net income. We know that from the income statement, don't we? And it's also saying, however, if the amount of expenses that we transfer into income summary are higher than the amount of revenues that we transfer into income summary, we have net loss. Again, we already know that. We already know that from the income statement. And if you've been paying attention at all, you know that net income or net loss is transferred to retained earnings. If you don't believe me, go back a few slides. We looked at a retained earnings statement, and that's precisely what we did. We took beginning retained earnings and we added net income to that. Did we not? We did. Step 4, the balance of the dividends account is transferred to the retained earnings account. Okay, so if we think about step 4, the statement of retained earnings is telling us, hey, whatever dividends, cash dividends we paid out during the year, that's a subtraction to retained earnings. It says here the balance of the dividends account is transferred to the retained earnings account. It could just as easily, and they have to say it because we're talking about the closing process, but it could just as easily say the balance of the dividends account for the period is subtracted from retained earnings. It's going to amount to the exact same thing. Okay. Now, you may be sufficiently confused, overwhelmed, but I think when we look at some of these examples, if you will pay attention and try, you can do this. But I will tell you that students typically have problems with the closing process. And the sad thing about it is that in the real world of accounting, you make all of your adjusting entries, and then you just press a couple of buttons, and all of this is done for you by the accounting software. But in school, no such luck. All right, so this is just a little diagram of what is taking place. It's those same 4 steps, 1, 2, 3, 4. So I'm not going to go over this any more than what I already have. Let's see here. Let's talk about this income summary account that we're using. It says income summary is a temporary account that is only used during the closing process. Okay, so I was a little bit ahead of myself there. They told us the exact same thing I already told you. Listen, at the beginning of the closing process, income summary has no balance. However, during the closing process, revenue and expense accounts are cleared by debiting or crediting income summary for their amounts. Okay, let's continue on. It says, because it has the effect of clearing the revenue and expense accounts on the income statement of their balances, income summary is sometimes called a clearing account, because this is the only purpose it serves, is to get those revenues to zero, get those expenses to zero, so that we can start a new year. Okay, so it says, let's look at some exciting closing entries. Well, I don't know if they're going to be exciting enough, but we probably ought to look at them. So, be very careful, and I want you to think about this. I'm going to go slowly here, and I think you'll be okay. It says here, the 4 closing entries required in the closing process are as follows. Now, we already looked at the 4 steps before, but now we're hopefully going to get a little bit more detail on how to actually do this. So listen. It says we're going to debit each revenue account for its balance, and we're going to credit income summary for the total revenue. Okay, now I want you to think about this for a second. Every time we made a sale, every time we recognized revenue during the year, we we increased revenue with what? Was it a debit or was it a credit? It was a credit. So in the example that we gave earlier, we said, let's just pretend that we have $100,000 of revenue for the year. Now at the end of the year, we got to get that off of the income statement. We got to get the income statement to show zero revenue. So we're going to debit whatever revenue amount we had to get it to zero. If we had a $100,000 credit balance for revenue, and then we debit revenue for $100,000 and credit income summary now has a balance of $100,000, credit balance, revenue is back to zero, which is what we wanted. Same thing for expenses. Credit each expense account, which we originally debited for its balance, and debit income summary. Okay? So we're going to both credit and debit income summary. Then, number 3 here makes a bit of an assumption. So I'm going to tell you, I'm going to add a little bit of language to this slide, and I'm going to say that assuming that we had net income, and in other words, assuming that revenue is higher than expenses, that means that after we complete these first 2 steps, income summary would have a credit balance. So using our example, we credited income summary for $100,000 in step 1. Now let's just suppose that all of our expense accounts together totaled $80,000. Okay, wages, utilities, everything. Depreciation was $80,000. What that means is that after step 2, income summary would have a $20,000 credit balance. 100,000 credit balance minus the 80,000 debit that we did here. So when they say to debit income summary, what we're doing now is we're getting rid of the balance in income summary. If we had a net loss, in the case of a net loss, we would have to credit income summary. Okay, so it says that right here, but, and in fact, I think I added that in a previous period and I forgot about it, but the fact that it starts off by saying debit income summary for its balance, I do want to indicate that is assuming that we have net income. Oops, didn't mean to jump forward like that. Step 4, debit retained earnings. The retained earnings account for the balance of the dividends account and credit the dividends account. Now this particular step right here, we will always debit retained earnings. We will always debit retained earnings because dividends are always going to be, dividends paid out are always going to be, dividends declared are always going to be a subtraction to retained earnings. Okay? All right. Post-closing trial balance. A post-closing trial balance is prepared after the closing entries have been posted. Okay? It says the purpose of the post-closing, after closing trial balance is to verify that the ledger is in balance at the beginning of the next period. Another way of saying that is that income statement and temporary counts should be at 0 or should not appear. And let's just focus on the 0 part here. I know why they're saying this, but it's not important that you know. Okay? So let's just think about this. If we go to our post-closing trial balance, what they're basically saying here is that the only accounts we should see are balance sheet accounts. If we see any income statement accounts, we have a problem. And also, if we see the dividends account on the post-closing trial balance, we have a problem. Only the permanent accounts should appear, or should at least appear. Those should be the only accounts that have a balance other than 0. Okay. most of the time, a post-closing trial balance, the temporary accounts are just not going to appear at all. They just simply should not appear. Okay. So here we have an example of a post-closing trial balance for Paul's Guitar Shop. And so if we look at this, we have asset, 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 contra asset, liability, 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 equity, and equity, stockholders' equity. Notice that only balance sheet accounts appear on the post-closing trial balance. And if you were to go back, we had an adjusted trial balance. If we were to go back and look, they're all jumbled up in here, but I seem to recall that when we looked at Paul's Guitar Shop income statement, they had $12,950 of $12,950 of net income. And based on some other things I saw, it appeared to me that Paul's Guitar Shop was a brand new business, meaning that in 2014 the business didn't exist, and for most of 2015 it didn't exist. Okay, if you remember from the and I'm just talking about the adjusted trial balance that we looked at for Paul's Guitar Shop, dividends showed up as $1,000, right? Look here at retained earnings, $11,950. That's the $12,950 net income from the balance sheet minus the $1,000 in dividends we paid equals this $11,950 here. Okay? So I just wanted to give you a little bit of insight into how we come up with those numbers. Looks like we got one more slide. I do want you to look over this. If you're hearing this lecture for an online class, I probably will not test you over these 10 steps here. And the reason is because you could simply just go back to this PowerPoint and you'd be guaranteed to get them all right. But what I would encourage you to do, whether this is an on-ground class or an online class, is I would encourage you to understand why these steps are what they are. This one right here, this end of period spreadsheet, I haven't talked about that. So, you know, if you want to skip over that one, that's fine. I just wanted to bring that to your attention. Normally, I think of the accounting cycle as being 10 steps as well. I would not include this, but I would break step 1 into 2 different items. Transactions are analyzed. To me, that's step 1, and then they're recorded in the journal. That's step 2, and then we could go down, and then minus this step 5 here, we would still have a 10-step process. Okay, so again, you're not going to be tested on getting the exact order of these, assuming you're in an online class, but if you understand why each of these is in the sequence that they're in, it should help you indirectly on your test. Okay, that wraps up chapter 4, and we'll get up some handout type videos shortly.